Top investors diversify their portfolios. They don't just put it into one stock. No, that is a bad move. If you want to mitigate your risk, then you need to diversify your investments, diversify your portfolios. And how do you diversify it, or where do you actually diversify these portfolios? In this short video, I'll take you through the different things you can invest in to ensure that your risks are mitigated. And watch this video until my last point, because that may just be the one that you truly need to become financially free. We all know investment carries risk. Yes, it does carry risk, because everything that gives you a reward must bring risk. The higher the risk, the higher the reward. And that's why if you look at those very aggressive, stocks or aggressive investments like crypto, the risks are so high because you can lose your money very quickly as much as you invested very quickly. Even stocks market, right? Even stock of some companies really just go down, or if they go bankrupt, for example. Now that's why you need to be very careful. You need to think very carefully. You need to think very strategically on the different things you want to invest in. And to do that, you need to understand that there are multiple things you can invest in. Do not put all your eggs in one basket. It's never a good idea. Depending on your kind of investment strategy and model, I want to tell you about a few things you can invest in. So you just go and think about it and see which one actually fits your model the more. One, you can invest in stocks. We already know that, right? Stocks goes up and it goes down, but if it goes up, averagely, if the company is good and it provide good returns, if it's a growth company, for example, chances are your stocks will keep going up over and over. Investing is a long-term game, so do not take down your stocks or sell them because it just went down or dipped a little bit. It's a long-term game, so you have to wait and watch it grow. But that's stocks, individual stocks, and they're volatile. Two are ETFs, which is a basket of stocks that hold top companies in the world, top companies in the US, technology companies that are doing very well, and you can invest in this, which actually gives you a lower risk than individual stocks. Now, do not leave your money in just stocks and ETFs. You can also buy REITs, for example. REITs is called Real Estate Investment Trust. And if you don't have money to buy, say, properties, for example, REITs is a good way because it gives you a little bit of capital appreciation, but it also pays you dividend on a monthly basis. And that's a good passive income you want to get. So I've talked about stocks, ETFs. Now there's REITs, which is Real Estate Investment Trust, and it gives you dividends every month, which is a good source of passive income. There are other things you can diversify your money into. Let's not forget real estate, which is a very stable investment. Now, one of the downside of real estate, obviously, is that people have to bring down payments and you may not have enough money for down payments. But if you do, real estate is a good investment for you to put your money in. And the reason is very simple. There are three basic needs in life, which is shelter, food, and clothing, right? So from a shelter perspective, that's where real estate fall in. Whatever country you live in, people live there too. And as long as people live there too, they need a shelter over their heads. And as long as that's true as well, then they need accommodation, which is real estate. Investing in real estate simply means you are investing in an industry that provides shelter over its citizens. And that's why you can never go wrong with real estate, because no matter what the economy does, or no matter how the economy moves right or left, in the long run, as long as people are still living in that city, in that country, real estate will continuously grow. There are other kinds of investments like businesses, for example. You can actually invest as an active investor or a passive investor in an existing business, which means you can just provide finance for a business to run while they pay you a certain return. But you can also buy out the business and run the business, which gives you enough cash flow over time as a good source of income rather than working 9 to 5. So we've talked about stocks, ETFs, REITs, buying physical properties, which is real estate, and buying a business as well, which is also very good. One other investment you can do is to act as an angel investor or a VC, which is venture capitalist. You actually invest in other people's business and take a percentage ownership of that business, or take an agreed upon interest rate or rate on return on that business over a period of time. So you can see there are multiple ways to invest. Do not just take all your money, which is all your savings that you've saved for the last 10 years, and dump it into one particular stock just because you feel like the stock is good. And hey, the stock might actually be good. That's the truth. But that's too much risk. Depending on the stage in life that you are in, you do not want to take that much risk. The best way, the safest way to ensure maximum return on your investment over the long period of time you choose to invest is to diversify your portfolio. My name is Nelson, guys, and I talk about personal finance, investment, wealth building, growth, savings, and budgeting. Follow me, like my videos so you can get more when I drop them.